Welcome to the Corporate Finance Institute. Thanks for registering for our course on e-commerce valuation. We're going to cover a lot of ground in this course, and I'm going to give a quick overview for you of what we'll cover. I'm going to introduce myself and my background and talk about some of the transactions that I've worked on in e-commerce. We'll then look at the e-commerce landscape and some companies that are in the space. We'll go over valuation metrics, how equity analysts or investment bankers value e-commerce businesses. And then we'll be ready to start building our financial model. We'll begin with setting out our key assumptions about the business, and from there we'll derive an income statement and a balance sheet. We'll make some supporting schedules for things like depreciation or interest calculations. And then we'll have a cash flow statement. Once all that's tied together, we will look at some very important customer metrics like customer lifetime value or customer acquisition cost. And finally, we'll do a DCF analysis of the whole business to arrive at a valuation. Once that's done, we can create some charts and output graphs so you can really wow management or investors or whoever you're giving this presentation to. My name is Tim Vipond, and I worked at shoes.com from 2014 to 2016 in the corporate development group. During that time, I presided over several mergers and acquisitions and capital raising, and I spent a lot of time building e-commerce financial models. So I'm really excited to do this course with you. And prior to that, I worked in investment banking as well as corporate development in some other industries. So I do spend a lot of time in financial models, and I look forward to building this one with you today. By the end of this course, you're going to be able to do several things. The first is you're going to be able to build the key assumptions that are required to value an e-commerce business. These are really the backbone of the model. From there, we're going to use all the formulas that are necessary to build an income statement, balance sheet, and cash flow statement. And then we'll calculate the value of the business using a DCF analysis. We'll look at customer metrics and unit economics and create some graphs. This course is critical for anyone looking at a career in e-commerce that relates to investment banking, equity research, corporate development, which is in-house mergers and acquisitions, or financial planning and analysis and treasury at an e-commerce company. By the end of the course, your final product will be a sophisticated and beautiful model that properly identifies all drivers, risks, and demonstrates the financial return of the investment. Now, let's get started. Now we're going to talk about key valuation metrics that are used in the e-commerce industry. These are critical to understand when building a financial model and understanding the outputs that most analysts are going to talk about. There are two main categories of metrics: customer metrics and financial metrics. First, a quick overview on the customer side of metrics. We're going to run through quite a few of these in detail, but at a high level, things like customers, customer churn rate, the average order value per checkout, the lifetime value or customer lifetime value as it's also called, the cost to acquire a customer, the total addressable market that you are trying to serve as a business, the average revenue per user, and net promoter score are all very important customer metrics to understand and will all be incorporated in our model in one way or another. On the financial side of these metrics, there are again quite a few to go through, but gross merchandise value is very important and referred to in some types of e-commerce businesses, but not in others. Gross profit or gross margin, dollars and percentages, the sell-through rate, the enterprise value per customer, the enterprise value relative to revenue, the enterprise value relative to gross profit, EV to EBITDA, and finally, probably one of the most important metrics, the lifetime value divided by customer acquisition cost. So let's go through those in a little more detail now. The first is active customers. Active customers is defined as the number of customers who have ordered in the last 12 months. That is the most common duration for an active customer. Some companies will define it over a longer time period, say number of customers who've ordered over 24 months or 36 months, depending on the type of business. 12 months, however, is the most common. The churn rate is the percentage of customers who are no longer active after the same period as you define your active customer base. So in this case, the number of customers who have dropped off after 12 months. The average order value, or sometimes also referred to as average order size, is the number of items per order times the price per item. This is the average checkout value. The lifetime value of a customer, or also sometimes called the customer lifetime value, is the net present value of contribution margin per customer. We're going to walk through this in more detail in the model, and there is a wide range of definitions of lifetime value in the industry. Some companies refer to the value of the revenue per customer over their life, some to the gross profit, and the most conservative is to the contribution margin dollars. But that's really the most important in understanding the actual economics of the business. Customer acquisition cost is the cost to acquire a new customer. The total addressable market is the annual value of all the goods and services in that market that you are trying to address. This is very important for investors to get a sense of how big the opportunity is. Average revenue per user is revenue divided by number of users. And finally, Net Promoter Score is a real good indication of how happy your customers are with your business and their experience buying with you. So we will run through an example of that later in the course, but it's conducted by survey. Now, onto the financial metrics in more detail. Gross merchandise value compared to revenue is a very different metric. The gross merchandise value is the value of all goods sold on a site. So for a marketplace type of business, this number would be very large. An analogy that I would draw is that if you are a realtor, a real estate agent, calculating the value of all the houses that you sold in a year would be your gross merchandise value. The commissions you earned from selling all those houses would be your revenue. So be very careful when companies are talking about gross merchandise value compared to revenue. They're very different numbers. Gross profit or gross margin is like any other business. However, in e-commerce, there is some difference with shipping or fulfillment. Some companies include it in their cost of goods sold. Other companies do not include it in cost of goods sold. It's not really too important one way or the other. The only thing that's important is that you understand whether or not it's included. The sell-through rate is the percentage of inventory sold over a period of time, in our case a year. The enterprise value per active customer is the market value of the equity plus the net debt divided by the number of active customers. This is a very crude metric. This is very far away from cash flow and not really a great indication of economic value. However, it could be interesting for a pre-revenue business or a business that's before profitability, and certainly is referenced in the industry. EV to revenue, we're now getting a little bit closer to cash flow. Again, the value of the equity plus the net debt divided by the revenue. Multiples of EV to revenue could range anywhere from 0.5 times to 3 or 4 times, depending on a variety of factors, and we'll get into that a bit later. EV to gross profit is again the enterprise value or equity plus net debt divided by gross profit. We're now getting a little bit closer to cash flow because we've adjusted for the gross margin, which can vary quite a bit across the industry. But again, shipping may or may not be included at this point, and therefore it's still not a fantastic indicator of economic value, but is getting a little bit warmer. And then finally, you've got EV to EBITDA, now getting much closer to cash flow, although still not all the way there. And this is the enterprise value of the business divided by the earnings before interest, taxes, depreciation, and amortization. Finally, lifetime value divided by customer acquisition cost. As you'll see the line being drawn on this graph, you definitely want this multiple to be more than 1, and ideally, 5+ times is a great number. So just to walk through an example with you, you take the contribution margin per customer and then you multiply that by the average customer life. So in this example, we're saying that we sell a product for $1,000, 70% is the contribution margin, the churn rate is 20%, which means the customer life is about 5 years, and it costs $500 to acquire the customer. In this example, we have an LTV to CAC ratio of 7 times. That would be a very high lifetime value to customer acquisition cost ratio. Before we get started building our model, let's take a look at the final product to see what we're going to design here. I've organized the model into several groups. These groups are laid out as assumptions, an income statement, a balance sheet, a cash flow statement, supporting schedules, customer metrics, the DCF valuation, and charts and graphs. The assumptions section up top is the only part of the model that has actual hard-coded inputs. I'm going to quickly scroll through these. These are all the assumptions we need to make to build the model. Things like site traffic, conversion rates, and order details, as well as some balance sheet and income statement items. Everything else in the model below that is only a formula. You'll notice that I have made formulas black color font and inputs blue color font. Everything from the income statement down is all black and is entirely formula based. I'm going to expand each of these so you can get a sense of what we're going to build here. Customer metrics are an output that will be important for analyzing the health of this business. The DCF valuation is where we will determine what this company is worth. And finally, we'll design some charts and graphs that will provide a nice output if you're presenting this to management or investors. Now, let's get started building the actual model. Alright, it's time to get started building our financial model, and we're going to begin with the assumptions section. The assumptions section is going to begin with an order buildup, which takes the various channels by which this business acquires customers and flows them through to actual orders. So in this case, we're talking about a business that has 4 different channels for placing orders. It has an email that it sends out to existing customers. It has organic search that drives traffic to the site, paid search that pays for traffic to the site, and affiliate marketing, which is also a paid form of traffic. There are many more channels than this, but this would be a typical breakdown of a normal e-commerce business. This is how we are going to build our model. We're going to need to make an assumption about conversion rates in each channel. The conversion rate is the number of orders per 100 visits, or the percentage of orders relative to traffic. So we will make an assumption of each of the 4 channels about conversion rates. And then we'll be able to figure out the number of orders by channel, as well as make an assumption about the number of items per order. And then the item value, the full retail value of the product that's being sold before any discounts or promotions. We'll then make an assumption about markdowns that will be made on items and discounts that will be made on any items. This will allow us to arrive at a net order value. And then we'll make an assumption about the product margin that we're going to be selling it for. So all of these assumptions combined, all of these boxes in blue, will drive our order buildup and will flow into the financial section of the financial model. Let's talk about customers and the customer buildup. We're going to have an opening balance and perform a corkscrew calculation for our customers. So we start with an opening balance at the beginning of the year. Then we add the new customers that were acquired during the year. We subtract from that the number of customers that churned or that were lost. And finally, that equals our end of year closing balance for number of customers. We're going to lay out some very specific assumptions for variable and fixed costs. On the variable cost side, we've got marketing, which consists of unit cost by channel, so cost per click, or in some cases cost per acquisition, depending on the type of marketing you're conducting. It's very important to do this by channel as it can vary quite significantly. We also have variable fulfillment costs, shipping per order, and labor for handling per order. Then on the fixed cost side of things, we're going to make assumptions as well. We're going to make assumptions about fulfillment, so warehouse rent and G&A costs. Again, rent for corporate offices, salaries, technology, and ongoing costs that are more or less fixed to this business. It's very important that we distinguish between variable and fixed costs so we can perform unit economic analysis of this business and really understand the contribution margin. We're going to lay out assumptions for balance sheet items. We need to know what our working capital assumptions are, and that includes the average accounts receivable days, accounts payable days, and average days of inventory or inventory turns. We'll need to know what capital expenditures are going to be, as they most commonly would relate to technology and equipment in the case of an e-commerce business. We're going to model our capital assets. We're going to need to show depreciation. We're going to need to look at financing and understand whether this business could have a line of credit, whether it should be funded with equity, if it's in a position to pay any dividends as well. And then all told, we can have a balancing balance sheet. In the next chapter of this course, we're going to open up the Excel file and walk through the financial model together. I'll explain again in more detail each of the assumptions we've gone through and explain how we're going to think about them, how we're going to input them, and then how they tie into the financial model and our valuation of this business. Now, let's get started. Please open the file entitled eCommerce Model blank. We're going to focus on building out the assumptions section of the model. The assumptions is what drives the rest of the model. This is where we keep all of our hard-coded assumptions, and the formulas flow from here later in the model. We're going to start by building up site traffic as measured in average monthly visits. If you recall from earlier in the course, there are 4 main channels for this business: email, organic search, paid search, and affiliates. We're then going to build up from monthly visits to annual traffic. We have an assumption for conversion rates, again by channel, a unique conversion rate assumption per channel, and that will drive the number of orders that are placed by channel. From orders, we will make some assumptions about average item value and number of items per order, as well as discounting and promotions. We'll build up our customer base, and then we'll get into some expenses and order fulfillment shortly. So let's start at the top here with site traffic as measured in average monthly visits. This is a startup, a brand new business, so there is no email database to begin with. We're going to have to jumpstart this business with a paid search campaign with Google or Bing or other search engines, and pay for some affiliate traffic through other websites. So I've keyed in some numbers here that kind of make sense to me for how a startup might look in terms of average monthly visits over the course of a year. Keep in mind this would be ramping up over the year from 0 in all of these channels on day 1. Please feel free to type in here whatever numbers make sense for you and your business. Once you've inputted the average monthly visits by channel, let's multiply those out to get the annual. Link to this cell and press F4 to lock it in place, and then multiply it by the top left channel. You can select the area below and press Ctrl D to fill down. Select the area to the right, holding Shift, and then press Ctrl R to fill right. For a review on any of these shortcuts, please take our Fundamentals of Financial Modeling course. Okay, conversion rates. I've inputted some assumptions for conversion rates by channel. You may want to update these with ones that make sense for your hypothetical business or your existing business. Once you have a conversion rate assumption, which just as a reminder is the percentage of people who place an order that visit your site, we can multiply those out by taking the percentage and applying it to the annual traffic in each channel. Again, select below with holding Shift and the down arrow, and then press Control D to fill down. Holding Shift and the right arrow, then press Control R to fill right. We've now filled in all of the annual orders that will be placed by channel, and below that we have the total orders that we expect to be placed each year. Below the number of orders, I've got a section called Order Details. These are critical assumptions that will drive economics of your business. The first is, what is the average item value that you're selling on your site? Whether you're selling socks, plates, electronics, or digital goods, you're going to need to have an item value. Then you're going to need to have an assumption for the number of items per order that customers are placing. This could range widely by industry or type of business, but it could be anywhere from 1 item per order to high volume, sort of 10 item per order type business. Then make an assumption about the average markdown that you might have to sell the product, or the promotion or discount code assumption. And then make an assumption about the cost of goods sold, or the product margin. The product margin is based on the undiscounted item value. I filled these in for us based on this startup. These are numbers that I believe to be reasonable for a generic business, but please update these for numbers that make sense for your business. Now that we have order detail assumptions and the number of orders that are going to be placed, we can calculate a couple of items here. One is the average gross order value. The average gross order value is simply the average item value multiplied by the number of items per order. The average net order value is equal to the average gross order value times 1 minus the average markdown minus the average discount or promotion. As you can see in this case, there's a fairly significant discount from the net value to the gross value. If we select both of these and the area to the right, we can use Control R to fill right. Now that the order details are in place, we can model the next section, which is customers. Alright, we've completed our financial model and valuation of the e-commerce business. Let's quickly review what we've done here. We've laid out a model that's highly structured with assumptions in one area. This contains all of the hard-coded inputs. Everything below assumptions is only formulas. We've then got our income statement, balance sheet, and cash flow statement, which flow from the assumptions, and also use some supporting schedules contained here. From all of the above, we can produce customer metrics which show the health of our business, how much it costs to acquire new customers, how much those new customers are worth, and the ratio of the two, which sort of illustrates the economic value. Finally, we've calculated the net present value of this business using a discounted cash flow analysis and created charts and graphs that can be outputted to a presentation. So in the assumptions section, we've clearly laid out in blue what we think the traffic will be to our website, how quickly that traffic will convert, the order details around the traffic, customer metrics and expenses, etc. We've built a nice income statement here, flowing from revenue all the way down to net income. And as you'll see, this business has, quite a serious burn rate in the first year, which is to be expected, as revenue is only a few $1 million in year one, but ramps up to 30 million after a few years. Let's take a minute to analyze our balance sheet here. So you'll see that because of the heavy burn rate of this business, the cash balance actually goes negative in 2019. This is a little bit tight, and I think we should go back up to the assumptions section and actually change the value of the equity that we raise to be 8 million. 8 million gives us a nice buffer here where we've got a couple million left on the balance sheet. That'll dilute our ownership a little bit down below, but this makes the model much more stable. We've got a cash flow statement here. We can see the operating cash flow hitting positive in 2019. Capital expenditures are not huge for this business. We raise our 8 million of equity on day one. We built supporting schedules to model our capital assets. So we've got technology, property, and equipment. We then also got a debt schedule. There's no debt in this model, but if we put it in the assumptions section, it will flow through here properly. Customer metrics, we've calculated our acquisition cost, contribution margin per order, and that feeds into the lifetime value. We get a pretty healthy LTV to CAC ratio out in these back years here. And as you see, the payback drops significantly where we're almost recovering the cost of acquiring a customer on the first order, but definitely have recouped all that cost by the second order. In terms of valuation, we've calculated a tax loss carry forward schedule here, which will impact our cash taxes due to the losses in the first few years. We've built up our unlevered free cash flow schedule, which is what feeds into the NPV analysis. We're using a discount rate or cost of capital of 20%. We use a terminal value of 8 times EBITDA. This represents a fairly normalized number that we could sell a business for. And then we add up the terminal value and the forecast period to get an enterprise value of 12.6 million. Relative to our 2017 revenue, this represents a multiple of 1.6 times. And finally, we retain 61% of the business after raising the $8 million upfront. Charts and graphs here are pulled from the information above. We've simply linked them. And we've now created these graphs that show the health of the business. So as you'll see, we've got our revenue ramp up, the profile of our EBITDA margin. This has been updated to now have a raise of $8 million, and as you'll see, we now maintain a more healthy cash balance in these lower years. So the burn rate is significant in 2016, breaking even here and then turning positive. Our customer metrics are healthy as the payback goes down in terms of number of orders, and the ratio of LTV to CAC goes up over time. Now we can take all the information from this model and put it into an investor pitch deck. Please stay tuned for our next course on how to build an investor pitch deck with the output from this model. Now that you've completed the course, you will receive your very own certificate of completion with a unique identification number that you can add to LinkedIn. Thanks, and we look forward to seeing you in our next course.